Imagine a whisper in the wind that suddenly turns into a thunderclap, shaking the foundations of the mightiest financial empire on Earth. 32,000 positions vanishing overnight, not a mere blip on the radar, but a profound tremor rippling through the core of global commerce. As nations everywhere pause, eyes fixed on the guardians of America's monetary fortress, this revelation cracks open a veil of invincibility, prompting a piercing inquiry. Could this be a fleeting shadow, or the harbinger of a domino effect unraveling prosperity worldwide? At its heart lies a perennial clash within the central bank's chambers, a duel of destinies decreed by legislative wisdom long ago. One front demands the ruthless quelling of rising costs to anchor value, while the opposing force champions the pursuit of full livelihoods for all citizens. These twin imperatives clash like opposing tides, one pulling back to restrain excess, the other surging forward to fuel momentum, a delicate dance where missteps could cascade into chaos. Over recent seasons, the scales have leaned sharply toward restraint. Confronted by a tempest of price surges unseen in generations, the institution unleashed a barrage of stringent measures, hailed as the boldest in contemporary annals. Borrowing costs escalated with fierce velocity, strangling liquidity flows, tempering property fervor, and willingly forfeiting bursts of expansion. The singular aim to restore equilibrium in valuations. Yet the workforce's unyielding fortitude served as the anchor allowing such audacity. Forces, however, bend only so far before fracturing. After weathering relentless strain, the vast machinery of production reveals weariness, momentum ebbing, public optimism flickering, and the international vista clouded by storms brewing in distant lands like the Old Continent and the Dragon's Realm. The canvas unfolds a tapestry of vulnerability, a fragile equilibrium teetering on the brink of upheaval from unforeseen jolts. This evaporation of livelihoods arrives as more than data. It's an urgent beacon flashed at the pinnacle of susceptibility. To unravel its full portent, we delve into the fracture's origins, probing if it holds the might to dismantle the edifice. If this narrative captivates, share your reflections below. Let's venture into this odyssey of discovery together, unveiling layers unseen. Picture a vast, intricate tapestry woven with threads of ambition, caution, and relentless pressure, a portrait of the global economic stage where every stitch counts. The sudden disappearance of 32,000 jobs in the United States isn't just a statistic scratched on a ledger, it's a fault line splitting open the ground beneath the world's financial colossus. To grasp why this tremor reverberates so fiercely, we must step back, survey the sprawling landscape, and uncover the unwritten laws that have steered the central bank's hand for over a century. Its authority, though vast, is tethered to a sacred pact, a dual charge etched in the annals of governance. Envision yourself at the helm of a colossal vessel navigating turbulent seas. This is the American economy, a behemoth of innovation and aspiration, yet fragile under strain. You command two levers, one to ignite prosperity by fueling livelihoods, the other to anchor stability by taming runaway prices. These are the twin pillars of the Federal Reserve's mission, a mandate that binds it to both nurture growth and guard against chaos. They are not allies but rivals, locked in an eternal dance where pressing one lever risks stalling the other. The first lever, prosperity, demands a gentle touch, low borrowing costs that breathe life into enterprises. Factories hum, startups flourish, and workers find purpose as paychecks flow freely. When this engine roars, unemployment fades, wallets thicken, and spending lights up the markets. It's a radiant vision, a cycle of abundance where dreams take root, yet push too hard and the machinery overheats. When demand outpaces supply, when every hand is employed but goods and services lag, prices spiral. A loaf of bread, a gallon of fuel, a home's deed, all climb beyond reach, eroding wealth and hope, especially for those clinging to fixed means. Here enters the second lever, stability. To quell this fever, the bank tightens the reins, hiking rates to cool fervor. Borrowing becomes a heavier burden, businesses shelve grand plans, and families pause before signing for that new car or mortgage. Demand softens, prices steady, and the specter of inflation retreats. But this medicine carries a bitter cost. Growth slows, confidence wanes, and most painfully, jobs vanish as firms trim sails to weather the storm. For 2 years, the scales have tipped toward this bitter remedy. A ferocious surge in costs, the worst in 4 decades, forced a relentless campaign. The bank, with steely resolve, raised rates at a pace unseen in modern times, constricting credit, dimming the housing market's glow, and embracing a slower stride to restore balance. The labor market, a bastion of resilience, stood firm, giving the institution courage to press on. But even the mightiest fortress has its limits. The economy, battered by sustained pressure, now stumbles, its pulse weakening, its spirit flickering. Across the Atlantic, the picture darkens further. Europe, a vital partner in trade, falters under its own burdens. Germany, the continent's engine, grapples with soaring energy costs and a manufacturing slump teetering on the edge of stagnation. The broader Eurozone creeps forward, its appetite for American goods waning. In the East, China's vast markets sputter, choked by a property crisis and fading confidence. When the world's workshop slows, its ripples drag global tides, and America feels the pull. This is a world on edge, a tightrope stretched taut. The loss of 32,000 livelihoods isn't just a number, it's a flare in the night, signaling a system strained to its breaking point. It arrives at a moment when every decision carries outsized weight, when a misstep could tip the balance from fragility to fracture. To decode this signal, we must trace its roots, not just in data, but in the global currents shaping its path. The central bank's crusade began in the shadow of a global crisis. Post-pandemic, massive aid flooded markets, but supply chains snapped and prices soared past 9%, a figure that shook policymakers and citizens alike. Under fierce scrutiny, the bank pivoted, wielding rate hikes like a blade to carve inflation down. Each meeting of its council became a global spectacle, markets hanging on every word, every hint of intent. The message was clear: no cost was too high to slay the beast of rising prices, even if it meant wounding the economy's vitality. The wounds are now visible. Housing markets, once vibrant, stand frozen under towering borrowing costs. Small enterprises, the backbone of innovation, strain under expensive capital. Even tech titans, long buoyed by cheap funds, have shed thousands of workers. The bank's calculated gamble, sacrificing short-term vigor for long-term calm, has tamed inflation's peak, but at a price. The economy, though cooler, is weary, its foundations trembling under global and domestic strain. Yet glimmers of resilience persist. American consumers, fortified by pandemic-era savings, have kept spending, defying the weight of high prices and rates. Until this report, the job market shone as a beacon of strength. But beneath this surface, fissures were forming. Core inflation, stripped of volatile food and fuel, lingers above the bank's 2% goal, signaling the fight is far from won. Growth metrics, factory output, purchasing indices show a system losing steam. Far from its post-crisis roar, confidence, both among households and firms, wavers as fears of joblessness creep in, casting a shadow over spending. This is the stage, a vessel battered but afloat, navigating treacherous waters. The loss of 32,000 jobs is a rogue wave, threatening to capsize the delicate balance. In Europe, where economic clouds gather, and in America, where optimism frays, this moment demands scrutiny. Is this a fleeting storm, or the first gust of a hurricane? The answer lies not just in numbers, but in the intricate interplay of forces: domestic resolve, global headwinds, and the bank's next move. As we peel back these layers, the stakes become clear. This is not America's story alone, but a saga that will shape markets from London to New York. The stage is set, the curtains drawn, and at the center of this unfolding drama stands a number that has sent shockwaves through the financial world: 32,000 livelihoods erased in a single breath. This isn't just a cold statistic, it's a pulse. A heartbeat faltering in the vast organism of the U.S. economy. To unravel its meaning, we must don the mantle of detectives, sifting through layers of data, chasing clues hidden in the shadows of spreadsheets. What story does this number tell? Where did it spring from, and why does it carry the weight to rattle markets from New York to Frankfurt? Let's begin by mapping the terrain. The U.S. labor market is scrutinized through three distinct lenses, each offering a unique angle on the same beating heart. First, there's the private sector pulse, captured by a titan of payroll processing, which will assume delivered this jarring figure of 32,000 jobs lost. This report, drawn from the real-time ledgers of countless businesses, serves as an early harbinger, a whisper of what's to come before the official drumbeat sounds. It's not infallible, but its tremors are enough to unsettle traders and policymakers alike, sending ripples across global exchanges. Then comes the cornerstone, the government's comprehensive tally of jobs across both public and private realms. This is the gold standard, a mosaic crafted from vast surveys of enterprises and households, painting the fullest picture of labor's health. Its release is a global event, with markets hanging on its every digit, knowing it sways the central bank's hand. Finally, there's a quieter but equally vital measure, a survey of open positions, a gauge of businesses' hunger for workers. It doesn't count jobs gained or lost, but reveals the appetite for growth, whether companies are still dreaming big or pulling back in caution. What happens when these lenses align in discord? If the job count falters but open positions remain robust, it suggests optimism persists. Firms are eager to hire but struggle to find the right fit. But when both signals dim, it's a siren of distress, a warning that the economic engine is sputtering. The 32,000 job loss, likely from that private sector snapshot, isn't just a forecast gone awry. It's a stark reality etched in payrolls, a sign that the cracks are no longer theoretical but tangible. Peeling back the layers, we find the pain isn't evenly spread. The sectors bleeding most are those tethered to the whims of consumer wallets and the sting of borrowing costs. Leisure and hospitality, once a roaring phoenix rising from pandemic ashes, now lead the retreat, with workers let go as families forego vacations and dining out. Manufacturing, a backbone of industrial might, sheds jobs as orders from both American and European markets dwindle, caught in the global slowdown's grip. Retail, too, falters, a mirror reflecting consumers' shrinking confidence, their purses tightening as uncertainty looms. This is the deeper truth. The wounds of a stringent monetary policy, once confined to high-rate-sensitive corners like real estate, have seeped into the economy's lifeblood, consumer spending. The shock lies not just in the loss, but in its betrayal of expectations. Analysts, armed with models and consensus, had predicted a healthy gain of perhaps 150,000 jobs. Instead, they were blindsided by a negative figure, a chasm of nearly 200,000 jobs between hope and reality. This isn't a minor miscalculation, it's a fracture in the foundation of economic forecasting, exposing how swiftly the tide has turned. Markets reeled not just from the number, but from its defiance of logic built on past resilience. A true analyst, however, doesn't linger on the headline. They dive deeper, flipping through the report's pages to unearth hidden truths. Consider the unemployment rate, a puzzle in itself. How can jobs vanish, yet the jobless rate hold steady or even dip? The answer lies in the labor force's ebb and flow, the sum of those working plus those actively seeking work. If 32,000 lose their jobs, but 50,000 others, disheartened, abandon their search, they vanish from the count. The labor pool shrinks, masking the loss in a deceptively stable or lower unemployment rate. This is no comfort, it's a silent scream of despair, signaling workers losing faith in opportunity. Next, the rhythm of wages, a beat the central bank monitors with hawk-like focus. Rising pay can spark a dangerous spiral. Higher wages push up prices, which in turn fuel demands for even more pay. The latest data shows wage growth slowing to a modest 3.8% annually, down from 4.2%. For the bank, this is a bittersweet note. On one hand, easing wage pressure softens inflation's grip, inching closer to their 2% dream. On the other, it confirms a grim reality. Businesses, squeezed by costs and fading demand, lack the will or means to boost pay. This foreshadows a weakening consumer engine as wallets grow thinner in the months ahead. Finally, the labor force participation rate, a measure of how many in the working-age population are engaged, either employed or seeking work. It's a barometer of hope, reflecting whether people believe jobs are within reach. A slight dip in this rate, as seen here, paints a troubling picture. The market's vibrancy is fading, its pulse growing faint as workers retreat from the fray. This isn't just a statistic, it's a signal of a society questioning its economic promise. When such a report lands, the world's sharpest minds leap into action. A Wall Street titan, speaking on a major financial network, called it bluntly, "This isn't a crack, it's a chasm." The speed of this decline signals the central bank has pushed too hard, too fast. Recession isn't a possibility, it's our new reality. A more tempered voice from a global news outlet cautioned, "One month's data can be noisy, but the widespread erosion across sectors is undeniable. The official jobs report will be our next clue whether this is a blip or a breaking point." A former central bank official, now at a renowned think tank, added, "Wait, this hands the doves a megaphone. It shatters the myth of an unbreakable labor market and makes a rate cut not just likely but inevitable." Across these voices, a chorus emerges. The labor market, once a pillar of strength, is crumbling faster than anyone foresaw. The pressure on the central bank to pivot is now a tidal wave, threatening to reshape policy from Washington to the trading floors of London and Paris. These numbers, dry on paper, weave a narrative of urgency, a call to action that echoes far beyond America's shores. Behind the sterile glow of data dashboards and the hum of economic models lies a human drama, a clash of minds steering the fate of global markets. The loss of 32,000 jobs isn't just a number, it's a thunderbolt that has jolted the inner sanctum of the world's most powerful central bank. To predict its next move, we must step beyond the graphs and into the minds of 12 guardians, economists, strategists, and visionaries, each wielding distinct philosophies shaped by experience and conviction. This is no mere policy debate, it's a battleground where ideas collide, where the future of prosperity from Wall Street to London hangs in the balance. Welcome to the eternal struggle between the hawks and the doves. In the lexicon of central banking, these are not birds but archetypes embodying rival visions for the economy's soul. Hawks, fierce and unyielding, fix their gaze on inflation as the ultimate foe. Like sentinels on a cliff, they see runaway prices as a wildfire that could consume stability, eroding wealth and igniting unrest. Their creed is clear: a healthy economy demands ironclad price control, even if it means tightening the screws with high interest rates, slowing the engine to keep the flames at bay. A hawk would argue that a brief storm of economic pain, a dip in growth, a rise in joblessness is a small price to pay to prevent the chaos of unchecked inflation. They are the guardians of restraint, the ones who grip the reins tightly. Doves, by contrast, carry a gentler torch, their eyes fixed on the horizon of opportunity. They champion the bank's other sacred charge, to foster a world where every willing hand finds work, where growth lifts all boats. To them, a touch of inflation is a tolerable shadow if it means vibrant factories, bustling shops and families with steady incomes. Low interest rates are their tool, a breeze to fan the flames of progress, encouraging borrowing, investment, and hiring. A dove would warn that squeezing too hard risks choking the life from the economy, casting millions into the uncertainty of unemployment. They are the dreamers of abundance, urging the ship forward even through choppy waters. Yet the council chamber is no simple battlefield of black and white. Many, including the bank's chair, stand in the gray, their stance fluid, swayed by the freshest currents of data. Policy isn't born from dogma but from persuasion. Whichever faction crafts the stronger case sways the neutral tide, shaping decisions that echo from New York to Paris. The 32,000 job loss is a seismic shift, a crack in the narrative of resilience that has tilted this delicate balance. It's a moment that demands we peer into the minds of these decision-makers, decoding their words and silences. Before this jolt, the chair's voice was a study in caution, a tightrope walk between restraint and hope. Statements like "we'll weigh the data carefully" or "risks are aligning" were diplomatic brushstrokes, neither hawk nor dove claiming victory. But the jobs report changed the air. In a fleeting address, the chair's tone sharpened. "This labor market signal is significant. We stand ready to act decisively to nurture growth." The shift is subtle but seismic, from measured indecision to a call for action. Laced with the dove's language of vitality, it's a sign the pendulum is swinging, the fear of stagnation now rivaling the dread of inflation. This pivot echoes louder among the council's voices. A known dove leading a regional outpost spoke with urgency. "I've long warned of the shadow cast by our tightening. This data confirms the toll. We risk far more by neglecting the labor market than by easing our grip." The words carry weight, a rallying cry for those who prioritize jobs over price battles. Even the fiercest hawks, those who've championed high rates with unwavering resolve, show cracks in their armor. One conceded, "The job losses raise concerns, but inflation remains our primary target. A single report shouldn't derail our course." The admission of concern is a fracture, a nod that the ground has shifted even if their resolve holds. Is a consensus forming? The signs point to yes. A handful of hardline hawks may cling to their stance, voting to hold the line, but the council's heart, its chair, its deputy, its pragmatists, leans toward action. The job loss data is a clarion call, arming doves with a narrative too potent to ignore. But why act now when the economy hasn't yet tipped into the abyss of recession? The answer lies in a doctrine as old as central banking itself: the preemptive strike, known as the insurance cut. Picture a sailor spotting dark clouds on the horizon. They don't wait for the storm to break, they batten down the hatches, adjust the sails, and brace for impact. So too with the central bank. Waiting for undeniable proof of collapse, skyrocketing unemployment, plunging output, risks acting too late. Monetary policy is a slow tide, its effects rippling through months, even years. An insurance cut is the sailor's foresight, a modest easing of rates to bolster the economy's defenses before the storm hits full force. History whispers of success. In the mid-1990s, such preemptive moves under a legendary chair stretched prosperity for years. A golden era of growth. The 32,000 job loss is that storm cloud, a warning too loud to dismiss. It offers the doves a perfect stage to argue that the cost of inaction, letting the economy slide into darkness, far outweighs the risk of a slight inflationary spark. Markets ever attuned to the bank's pulse are already placing bets. Tools like futures trackers, which distill the wisdom of traders, signal an overwhelming likelihood, 85%, that a quarter-point rate cut will land at the next meeting. Holding steady, a mere 15% chance. The numbers tell a story of inevitability, a pivot not just possible but nearly certain. This internal drama, this clash of hawks and doves, isn't confined to a Washington chamber. Its outcome will send shockwaves through global markets, shaping the cost of borrowing in London, the price of goods in Berlin, the confidence of investors from Dublin to Dallas. The 32,000 job loss has tipped the scales, and the world waits to see how far the pendulum swings. As we stand on this precipice, one question lingers: will this be a gentle correction or the prelude to a deeper unraveling? The answer lies in the minds of those 12, and their next move will write the next chapter for us all. A single decision, forged in the quiet chambers of Washington, sends tremors that race across oceans, shaking the pillars of global markets. The central bank's pivot, sparked by the loss of 32,000 jobs, isn't just a policy shift. It's a stone dropped in a still pond, its ripples reaching from the trading floors of New York to the financial hubs of London and Frankfurt. Why should you, whether in a Manhattan high-rise or a Berlin cafe, feel the weight of this moment? In our woven world, a whisper from the Federal Reserve can stir a storm, touching your investments, your savings, your future. Let's trace these waves, from Wall Street's pulse to the rhythm of your wallet. The first to feel the quake is the stock market, a barometer of hope and fear. A shift toward softer policy, lower interest rates, is a spark for equities, especially for the high-flying tech and growth sectors. Why? Three currents converge. First, cheaper capital. Firms, especially those in innovation's vanguard, thrive on borrowed funds to fuel research, build products, and conquer markets. Lower rates lighten this burden, like a weight lifted from a sprinter's shoulders, boosting profits and ambition. Second, a mathematical lift. Stocks are priced by projecting future earnings and discounting them to today's value, using rates as the yardstick. High rates shrink those future profits in today's terms. A cut reverses this, inflating stock values as if by alchemy. Third, the pull of necessity. When safe havens like savings accounts or government bonds yield meager returns, investors, restless for gains, pour capital into stocks. This flood can lift entire indices, a rising tide for portfolios from Chicago to Paris. Bonds, too, dance to this tune, locked in an ancient rhythm with interest rates. Picture a bond you bought last year promising a steady 3% return. If new bonds, issued after a rate cut, offer only 2%, your bond becomes a rare gem. Investors will pay more, perhaps a premium, to secure its higher yield, driving up its price. This inverse waltz between rates and bond values is a cornerstone of finance, felt in pension funds and portfolios across the Atlantic, from London City to Munich's markets. Then there's the U.S. dollar, the world's financial anchor. Its strength tied to the lure of American rates. When the bank tightens, the dollar shines, drawing capital like a magnet as investors chase higher yields. A rate cut dims this glow. Funds flow outward, seeking better returns in euros or pounds, nudging the dollar downward. This shift, tracked by the dollar's global index, reverberates through currency markets, altering the cost of trade and travel from Dublin to Dallas. Commodities like gold and oil catch the next wave. Priced in dollars globally, they thrive when the greenback weakens. A softer dollar means European buyers, wielding euros, need less to buy the same barrel of oil or ounce of gold. Spurring demand, or seen another way, more dollars are needed to claim that same ounce, pushing prices higher. Gold especially gleams brighter in low-rate times. When bonds yield little, holding non-yielding gold costs less in missed opportunities, making it a beacon for those seeking safety amid uncertainty. These ripples don't halt at borders, they reshape the economic seas for Europe and beyond. First, consider currency dynamics. A weaker dollar eases pressure on the euro, stabilizing exchange rates for Eurozone exporters. Firms in Germany or France, reliant on U.S. markets, find their goods more competitive as the dollar's strength fades. This shift also lightens the load for European companies with dollar-denominated debts, freeing capital for growth. In the UK, a stronger pound against the dollar boosts purchasing power for imports, from American tech to raw materials. Second, the dance of interest rates. As the US eases, European central banks like the ECB or Bank of England gain breathing room. When American rates soared, these banks faced a dilemma: match the hikes to prevent capital flight and currency pressure, or keep rates low to nurture fragile recoveries. A US pivot toward lower rates lifts this bind, allowing Europe to hold or cut rates without fear of destabilizing the euro or pound. This is a lifeline for businesses, from small Berlin startups to London manufacturers craving affordable capital to expand. Third, the hunt for yield. In a low-rate US environment, global investors commanding trillions seek higher returns in vibrant markets. Europe, with its mix of stable economies and growth potential, becomes a magnet. Capital flows into Eurozone stock markets, lifting indices in Frankfurt and Paris. Direct investments surge as multinationals, flush with cheaper US capital, build factories or tech hubs in places like Ireland or the Netherlands. This influx fuels jobs and innovation, a boon for communities from Amsterdam to Austin. These waves carry both promise and peril. A dovish turn in Washington is a tailwind for European markets, easing currency strains, lowering borrowing costs, and drawing investment. But it's not without risk. If the US cuts rates too swiftly, reigniting inflation, Europe could face imported price pressures, especially in energy and commodities. The interconnectedness of our financial world means no market stands alone. What begins in Washington reshapes the economic landscape for millions. This is the power of 32,000 jobs lost, not just a number, but a catalyst rippling through the arteries of global finance. From soaring stocks to shifting currencies, from gold's gleam to Europe's renewed vigor, the central bank's response will touch every corner of your financial life. Whether you're an investor watching indices in London, a business owner borrowing in Frankfurt, or a family budgeting in New York, these decisions will shape your choices, your risks, your opportunities. As the bank prepares its next move, the world holds its breath, knowing the ripples will soon reach us all. We've sailed through a storm of numbers, navigated the turbulent minds of policymakers, and traced ripples that stretch from Wall Street to the cobblestone streets of Europe. The vanishing of 32,000 jobs is no mere footnote, it's a clarion call, a crack in the bedrock of the world's economic titan. This moment has shifted the tides within the central bank, tilting the scales toward those who champion growth over restraint. Setting the stage for a pivotal turn in policy. What lies beyond the horizon? The path is shrouded, but three futures beckon, each with its own promise and peril. First, the soft landing, a delicate maneuver where the bank's gentle easing steadies the labor market, guiding the economy to a smooth glide. Growth slows but holds, a pause before a steady climb, a beacon of hope for markets from New York to Frankfurt. Second, the shadow of recession. The job losses mark the edge of a deeper plunge, where rate cuts falter and the economy spirals into stagnation, chilling confidence across London and Paris. Third, the specter of stagflation, a grim dance of high prices, joblessness, and stalled growth, trapping the bank in an impossible bind, its echoes felt in every Eurozone household. Which path will unfold? The answer lies in the choices ahead, not just in Washington, but in how markets, businesses, and you respond. Will you see opportunity in the chaos or brace for turbulence? Share your vision below. Your voice matters in this unfolding saga. In an age where certainty is a fleeting guest, clarity is your shield. Stay vigilant, diversify your sails, and chart your course with care. This analysis is a map, not a compass, offered to inform, not to steer your financial fate. If this journey sparked insight, share it with those who seek truth. And join us for more by subscribing and ringing the bell. The next chapter awaits, and we'll navigate it together. Thank you, and until the next tide.